Hey everyone, welcome back. I'm Giselle from HomeQualifiers. And today I want to talk about something I genuinely see derail people every day working in the home ownership and credit industry. Most people think that just because they're paying their bills on time and keeping their credit card balance somewhat reasonable, they're going to be approved for a mortgage in 2026. But that's actually not always the case. There are financial habits that seem on the surface completely harmless, but are silently triggering red flags on your account. And most people have absolutely no idea that they are doing them. So I'm gonna go ahead and walk you through 5 today. And I promise you that by the end of this video, you're gonna see your daily money habits completely different. So one of the triggers I see is unseasoned accounts. And I feel like this one trips people out all the time. So when you open a new credit card account, whether it's a new credit card, whether it's a credit builder loan, or just any new line of credit, that account is considered unseasoned, which basically just means that the account has not been opened long enough to show a pattern of responsible use. And I feel like lenders take a look at these accounts and they get nervous because they don't know if you're gonna manage that account correctly or if that account is probably going to give you some problems down the road. Here's where people make the mistake. You hear, right, that you need to build your credit to be able to be approved for a home. So they go and then they try to open like 3 accounts at once. A new credit card and a store credit card and a credit builder loan. And they think that they're doing the right thing. But what's actually happening is 3 hard inquiries are hitting your account at once. And these 3 new unseasoned accounts are going to lower your average credit age and your score is going to drop right before you decide to apply. So try to do this instead. If you're planning to apply for a mortgage in the next 6 to 12 months, do not open any new accounts. If you are earlier in your credit building journey, open accounts strategically, okay? So that means opening one at a time, making sure that there's enough time to kind of just like you have some smart use in it before you try to open and add a new unseasoned account. Moving on to trigger number 2, fluctuating credit utilization ratios. What is that? This one is really sneaky because I sit here and preach, right? Under 30% utilization is where you need to be at. So a lot of people know that and they try to keep up with that. But here's what the mortgage underwriting system actually looks at. So it's not only just about where your utilization sits at today, right? When you're about to apply. They actually take a look at the pattern you have had of utilization in the last several months. So if your credit utilization is jumping around high one month and then low the next, that is inconsistency. That might make a lender believe that there's financial inconsistency and that your financial situation is unstable. So the goal is not just low utilization. The goal is going to be consistent low utilization. So please try to keep every single credit card you have at the moment under 30% of utilization. Of course, ideally we want 10%. Just don't let it spike too much. Don't let it get out of control because like I said, that might show financial inconsistency. Trigger number 3, large unexplained deposits. I think this one surprises people all the time because they think, oh, the more money in my bank account, the better. And it is, right? It is, but only if lenders can track where this money is coming from. So here's why this matters. A lender has to make sure that the income that you're bringing in comes from a legitimate source because that's going to be the money you're going to be putting for your down payment. Mortgage lenders have to verify that your down payment and any reserves are coming from a legitimate income source. They cannot approve a loan if they can't prove where this money is coming from. Why is there like a random $5,000 that just like magically appeared in a month in your bank account? So they're gonna ask questions, and if you cannot document where that money came from, your process is just gonna stall. So just remember, the fix is very simple. Document everything. If family members give you money as a gift, ask them to write a letter. If you sold something, get a receipt. If you transfer money from another account, just make sure you have that paper trail. Every large deposit needs an explanation. Trigger number 4, job changes right before applying. I see this one constantly, someone gets offered a better paying job and they automatically just accept it. Just because, it might be around the time that they're planning to buy a home and they think, oh, this is great, more money, more income, that means higher approval odds. But not necessarily. So here's how lenders think about employment. They just want to see stability, consistent, verifiable income over time. And when you change jobs, even for more money, you're going to reset that clock of consistency. Most lenders want to see 2 years of stable employment history in the same field. So if you're planning to buy a home in the next 6 to 12 months, do not change fields, do not change employment, do not switch industries, do not go from salary to commission. Lock in your employment stability and let your income history speak for itself. And the last trigger I will be talking about today is trigger number 5, ignoring small collection accounts. I think this was like the most overlooked and probably the most avoidable one, ignoring small collections on your credit report. I see this all the time. Somebody pulls their credit report and then we see a collection and it was for like $47. Maybe it's like an old medical bill or a forgotten utility payment from years ago, and they think, oh, it's not going to affect me that much. It's such a small amount. It's probably not going to do that much damage. It is more damaging than you think. A collection account, regardless of the amount, tells a lender that this person owed money and they didn't pay it. Simple as that. And if you're going to buy a house, obviously they're going to have second thoughts. Like, come on, this dude couldn't pay $47. How is he going to pay a $300,000 mortgage loan? Here's the other part though. Not every collection on your account is reported accurately. Some are reported incorrectly, or some just flat out belong to somebody else. Some are past legal reporting windows and maybe just shouldn't be there anymore. It's very important to know anything that is unverifiable or inaccurate on your report can be disputed and potentially removed. So do not ignore the small stuff. Now, here's the thing. Knowing all of these triggers is step 1, but actually managing all of these simultaneously while also trying to build your credit, build your down payment, and just figure out the whole mortgage process, that's a lot to carry alone. And that's exactly why I want to share this amazing platform that is HomeQualifiers. I cannot recommend this platform enough because it just does all of the heavy lifting for you. HomeQualifiers is going to automatically scan your entire credit report. It's going to identify anything that is hurting your score. So I know we just talked about old collections and all of that. It's going to go ahead and identify just anything that is dragging your score down. Then it's going to generate legally precise dispute letters tailored to your specific items. And those letters will be sent to 12 credit bureaus, not 3 like all the traditional credit repair services out there. And on top of that, we're going to help you build a personalized home ownership plan specific to your situation. The link is going to be in the description down below, and this whole entire process is only going to cost you $50 a month. I genuinely think this is one of the smartest investments you can make on your path to homeownership. And of course, if you found this video helpful, please subscribe, give me a like, give me a comment. Every Wednesday, I drop a new video about the things maybe we were never taught about in credit or homeownership. Everything in this channel is information from somebody that works inside the credit and home ownership industry, and from someone who wants to see you win. See you next week. Let's get you into a home.